Good afternoon, everybody. Joe Lucey here for another Market Huddle. Back by popular demand probably is Andy Ives. I'll tell you, every time we have you on, Andy, we get more great comments afterwards about the material you're sharing. So I want to thank you here before we jump into things too much, and just thank you again for being a good partner of ours. Andy is one of our subject matter experts through the Slott organization. He's the guy I call when I don't have an answer, and he helps me give you guys the right answer. So welcome, Andy.
Thank you. Happy to be here.
All right. So this week, guys, trying to come up with some material. And by the way, I thought I had today off, and then I realized I had this. So the flannel jersey is going on here today, but I'm glad you all could be here. I am going to kick this off, Andy. I'll let you stay in the picture there. Okay. But this week we were talking about what a unconventional year last year was. Me and Andy had a conversation here a week or so ago about another specific situation. But started talking about all the different things that happened that didn't happen, maybe is a better way to say it, in 2020, that now we're coming back in 2021, and how there's going to be so much confusion with so many retirees about what they can or can't do or what they should be doing. And you know, I don't know if the media has really done a great job of talking about this or some of the things you need to be thinking about. So anyways, this week we're going to talk about 3 items here that I think everybody that's on the call probably needs to keep on their radar. Some of them are going to be a little bit more specific to families that are over 72 because of required distributions, or at least one of them is. But there's also a lot of material for everybody. So as usual, if you have any follow-up questions, if you would like to visit on this, whether you're a client or not, we want to be a resource here at Secured Retirement Financial. So give us a call at the end here. We'll make it available that everybody can get on the calendar and we can have a discussion around that. Without further ado, you know, Andy, I'm going to go ahead and let you take over from here and talk about 3 items we need to consider this month, or this year anyways, after the unconventional 2020, and why this has occurred, and what everybody should be looking at as they start to plan for 2021 to make this the most a very successful year for themselves.
Yeah, thank you very much, Joe. And I'm going to skip these slides ahead a little bit. So there's the first slide. Joe asked me, you know, what are some things that are going on? We talked about some ideas, and we're only 2.5 weeks here into 2021, and these 3 things I think are important items to think about, and it seems pretty basic. And we're going to look at these from a little bit of a unique perspective. We're not going to talk about them as you might think, but IRS Form 1099-R seems kind of bland, but there's some interesting components there when we look at it. QCDs, qualified charitable distributions. If you're not familiar with those, we'll talk about those a little bit as far as the detail. But again, looking at them from a different angle. And the same thing with Roth conversions, a little bit of a unique perspective on them based on the craziness that was 2020. So the next page here, consideration number 1, IRS Form 1099-R. Now, most of us know that if you take a distribution from an IRA or from a work plan, you're going to get a 1099-R. That 1099-R is going to show the taxable distribution. They typically come out at the end of January, so it's probably going to be a couple of weeks. If you took a distribution, you're probably going to see one coming pretty soon. The thing about 1099-Rs, though, is they don't tell the whole story. It's only a part of the story with a 1099-R. For example, let's say a person was under 59.5. And when you're under 59.5, you can get at your IRA, but there's typically a 10% penalty for an early distribution. But there's some exceptions out there. If a person is under 59.5 and they want to take some money out of their IRA, let's say $50,000, to pay for their child's college education, you can certainly do that. However, they're going to get a 1099 that shows a $50,000 distribution. There's going to be no tax code on there that says it was for higher education. The custodian doesn't know. The custodian has no idea that the person used those dollars for higher education. So it's incumbent upon that tax filer to do some additional accounting, some additional reporting. They get their 1099, then they have to show receipts. They have to show on their 1040, this is what I did. They file Form 5329. I use this for higher education. There should be no penalty. The same applies for rollovers. You get your 1099. It doesn't show that you did a rollover. The custodian has no idea if you took the money from custodian A and walked it across the street and roll it over to custodian B. They don't know. So you're going to get a 1099 showing the distribution. It's up to you as a tax filer to do the additional accounting to show on your 1040, line 4A, 4B, yes, I did the rollover, and you're good to go. Why is that important? I think that we have a significant amount of people that did rollovers last year that had never done a rollover before. And who are they? Look at that next bullet point. Replaced RMD, question mark. Last year, the CARES Act waived RMDs. There was a whole bunch of people that took their RMD early. The required minimum distribution was paid out early in the year. And then the CARES Act came and RMDs were waived. They said, I want to put it back. There was a bunch of people that had an automatic distribution sent to them of their RMD, because a lot of times they're set up to be automatically paid out. And they got the payment and they said, I want to put it back. So they did it. They put that money back in. It is a rollover. Recognize that you will, if you did that, you will get a 1099 showing a distribution of that amount. And it will not say that you put it back. So don't panic. This is where the additional accounting comes in. You're going to get your 1099 showing that you took the RMD. When you file your taxes, you're going to show, yes, I put it back. And then in May, another form is going to come out. And it says there at the bottom of the page, Form 5498. Do you have to wait to file your taxes before you get that form? No, you do not. Form 5498 is for informational reporting only. It does go to the IRS, and it goes to you as the person that did that rollover. So when it's all said and done, the 1099 shows the payment out of the IRA. You do your additional accounting to show the IRS when you do your taxes. And then the 5498 substantiates your taxes. It basically offsets the 1099. So be aware of that. If you did put your RMD back last year, don't panic when you get your 1099. In a similar vein, consideration number 2, qualified charitable distributions. Now, these are a way to move money directly from an IRA to a qualified charity, and it removes that income. So if I have a $10,000 RMD, let's say, I can move $10,000 from my IRA to a charity, and it basically eliminates that income from me. You have to be 70 and a half to actually do a QCD. I know they're very popular, but look at that first bullet point. QCD is not indicated on a 1099-R. So similar to rollover, the custodian has no idea if you're doing a QCD with this. And if it does go to a charity, because it has to go directly to a charity, the custodian is not going to police whether or not that charity is a qualified charity, because it's got to go to a qualified charity to count as a QCD. So communication with the tax preparer is key. And here's why. Look at the combination example I put on there. Let's look at last year. Let's say a person had a $15,000 RMD. It paid out to them automatically. They got this RMD. CARES Act waived RMDs. They said, I want to put it back. So they put it back. 6 months later, now let's say it's fall time of 2020. They say, I'd like to give $10,000 to my church. So they do a QCD of $10,000. And they do it properly. Money goes directly from the IRA to the church charity. What are they going to get at the end of the year, early part of this year, on a 1099? A 1099 that's going to show $25,000 paid out. The custodian doesn't know anything else. They know nothing less than what they see. Now it's incumbent upon the tax filer to communicate with their preparer what they did. If you just dump the documents on the CPA might see that a rollover was done by looking at a statement. They might see that a QCD was done, but I wouldn't want to bet on that. So communication is key. It says the fix. We talked about the 5498, how that can offset the 1099 and proper tax reporting. Another thing that Joe and I were talking about here as well, QCDs don't show up on a 1099, and neither do CRDs, if you've heard of a CRD, a coronavirus-related distribution. They were popular in the news. I don't know if a lot of people did a CRD. Basically, the CARES Act allowed people to take up to $100,000 from their IRA or plan. 10% penalty was waived. They could pay the money back. It no longer exists. You cannot do a CRD anymore. It expired in December 30th of 2020. But interestingly enough, a CRD doesn't show up on a 1099 either. Again, only part of the story there. So this segues as we look at 2020 and the unique characteristics and things that happened in 2020. We know that people rolled back their RMDs that were waived. That was unique. We know that the 1099 doesn't show QCDs, but now we've got this one. It says some people got their first Roth conversion experience last year with an RMD conversion. I will say from experience, my parents fall into this situation. They never had a Roth in their life. They did a Roth conversion last year of their required minimum distribution. The strategy here was, and I think it was pretty smart, and a lot of people took advantage of this, was if I have already budgeted to pay the taxes on my RMD, instead of putting it back, why don't I just do a Roth conversion? Because I can convert those dollars. Now, in a normal year, you cannot convert an RMD. RMD's got to be taken. You can't do a conversion of it. But last year in 2020, once they were waived, that dollar amount became just a normal distribution. So a lot of people did Roth conversions. 2021, RMDs are back in effect. So if you are in that category of over age 70 and a half from before the Secure Act or 72 going forward, note that you cannot convert your RMD. You can still do Roth conversions, but you've got to take your RMD first. So whatever that amount is, it's got to come out first, and then you can do conversions over and above that into a Roth. I put this next section on here called bracket bumping, and this applies to everybody. It doesn't matter if you're 35, 45, 75, 85. Anybody can do a Roth conversion. Doesn't matter if you have earned income or not. Doesn't matter how big your IRA is. Anybody can do a Roth conversion. But it's a good idea to keep an eye on how much you're converting. And I know Joe's team is good with this because there's a number, and he can talk about this. I don't know, Joe, if you want to jump into this here at the end. There's a number of items that a Roth conversion could impact. So before I get into this, maybe you can talk about a little bit about that.
Well, the one thing as you're going through here, and I know that we'll probably have some time for some questions and such, and I might add a little color as we're waiting for that to come in, is that there's a lot of potential problems that families run into if they just kind of go at these Roth conversions without some planning. Many of you have even seen this in your own planning. Stealth taxes, where you end up paying additional Medicare premiums for the money that gets moved. Now, keep in mind, just because you're paying an extra Medicare premium doesn't mean that you shouldn't do more or a greater Roth conversion. It really depends on your own personal situation. How much money do we eventually want to try to get untaxed from? But, there's these Roth conversions that occur. We had some clients last year calling because maybe they would have benefited or been eligible for a stimulus plan, yet because of a Roth conversion, it kept them from being eligible. Keep in mind, we're talking about a small amount of stimulus here that we are looking at saving a lifetime of taxes on, but it is something to consider. A lot of these stealth taxes, I actually wrote down one as you were talking, and I lost it, but the capital gains, you get too high, you got to pay capital gains. Loss of other deductions. Again, the Medicare premium is the one that kind of comes into play here. So we want to make sure that we're looking at the entire picture. And that's really when we sit down, let's look at your own personal situation. Let's come up with a strategy. We still have a plan here, because of the Tax Acts and Recovery Act, basically the Trump tax plan. We know that best case scenario, that is only going to be in place here until December 31st of 2025, means that in 2026, the tax plan we're under will likely expire, could even be earlier. We'll maybe even find out more on that as soon as next week. But we have a situation where we want to try to take advantage of the low tax rates, lowest than we've seen in 40 years, but do so in a smart, methodical, a strategic way. But you bring up a good point, Andy. A lot of times it does make sense, especially like if you're in the 22% bracket. One of the discussions we oftentimes will have, the difference between 22 and 24% is only 8% increase. It's not near as steep a jump as going from a 12 to 22 or the 24 to 32. And it really comes down to your own situation, your own specific planning that we're putting together for you. So in a bit, we'll make sure that everybody has an opportunity to get on the calendars if that's something they'd like to discuss a little deeper.
Yeah, and I agree. You got to be smart about the Roth conversions. So a bracket bumping strategy is what some people call it. So for example, if you look at these brackets here, the second column there for married filing joint. If you're a couple married filing joint, and let's say after your standard deduction or whatever, and you total your income for the year, and let's say you're at $102,000 total income. You technically have about $70,000. You get a $70,000 amount before you start to bump your head on the 24% bracket. So that's the bracket bumping strategy. How can I convert it enough to just get me to that next bracket without going over? But you got to be careful of the stealth taxes that Joe mentioned. So looking back at the example I talked about, the person that took a distribution to pay for the college education of their child, if that child maybe was receiving some benefits, some financial benefits based on income, on what his parents are making. If they do a Roth conversion, that financial aid could possibly be impacted by that Roth conversion. So those are the stealth taxes that Joe was talking about. But anyways, you can see an idea of what the 2021 brackets are for this year, give you an idea of what you can do with conversions. But again, I have to emphasize, just to be careful, do not try to convert your RMD. It'll be an excess contribution, and you got all kinds of problems at that point. So take it first.
Yeah, and Andy, there's a whole lot of our clients that are would have taken their first RMD last year, and then because of the Secure Act, which made some changes to who has to take an RMD, and the CARES Act didn't, and so now we have a whole new class of required minimum distribution clients, those that have never had to take a RMD in the past. So I know that a lot of times there's some confusion about that. We want to be a resource. Interesting little nugget, I guess, that I wasn't 100% convinced on. I knew that if I turned 72 this year that I had until April 1st of next year. But you're telling me that because of the CARES Act and those that could have or should have taken it last year but didn't have to, there's actually some families out there that could even wait until April of next year to take that first RMD. But keep in mind, if you've taken an RMD in the past, your deadline to take that money out of the account to avoid the 50% penalty, it's probably the steepest penalty we see out there, is you have to take that money out before December 31st. Good rule of thumb. Take it out if you can afford to tax-wise this year. There's some limited situations where waiting till next year makes some sense. Did you have anything to add around that, Andy?
No, you're absolutely right, though. We are at a very squirrely time where the Secure Act is taking over for the old rules, and people can easily get confused as far as when their RMD is or isn't supposed to kick in, if they're right on that age of 70 and a half before or 72. So absolutely, if you're concerned or have questions about it, check with Joe and his team, because it is a weird situation for everybody right around that age group.
Let's do this. I'm going to go ahead and open it up. If you would like to schedule your review, there should be a link that shows up on your computer screen there. You can schedule that. But let's go and answer some questions. Does anybody have any questions? Even if it's not necessarily related to these three areas, but it's around retirement planning. That's Andy's area of specialty and such. So if you have any questions, we'll go ahead and try to answer those right now. I think, Andy, one of the things that actually made last year a little bit more unique than so many really does come down to, number one, the Secure Act that didn't get passed until December, came into effect here January 1st. And it changed so many different things. The one we've talked about, required distributions going to age 72. But even outside of that, it expanded the amount of investments that could go into your company plans. It really made a lot of changes around inheriting retirement accounts. Talk a little bit about some of those changes, because I think that a lot of families may not be aware of some of the changes that occurred there. Basically, you have to take out all of your IRA assets in a 10-year period of time. That means your beneficiary, if it's a non-spouse beneficiary, there's some exceptions for disabled children or someone that's within 10 years of you. But for the most part, most of your retirement accounts will have to be emptied in just 10 years following the passing of a second spouse. And it probably has changed some of the ways that we want to be thinking about some of our estate planning. Go ahead, Andy, on that.
Yeah, I agree with you 100%. That's one of the biggest changes, the Secure Act. It used to be that if I was the beneficiary of someone's IRA and I inherited that IRA, I could stretch out the payments. I could elongate the distribution amount based on my single life expectancy. That's not always the case right now. For many beneficiaries, you're looking at a 10-year payout, and it's quite significant. So if I look at, I have my single life expectancy chart here. So hypothetically, if a 40-year-old person, let's say a 40-year-old son of an older adult, were to inherit their IRA, back in the day, you're looking at a 43.6-year stretch of those payments. It would take 43 years if they took the minimum amount to empty the IRA. Under the Secure Act, that 43 years is eliminated. That goes to a 10-year payout, unless you are what's called an eligible designated beneficiary. And it's a group of spouses. It is disabled, chronically ill, minor children of the account owner. So if it's your grandchild, even though the grandchild is a minor, that doesn't count. It's got to be the minor child of the account owner.
That one there is probably the number one area that I've had some discussions with. Even a state, somebody that's sometimes we'll have a discussion with an attorney that's drawing up some documents, and us pointing that out. A lot of attorneys, some of the professionals may not have caught that point. So it's something I think we're going to see some mistakes around, actually.
Yeah. And I'll tell you another one. Another biggie is trusts. If you have a trust as your IRA beneficiary, and that trust was put into place prior to the Secure Act, so 2019 or earlier, it has got to be reviewed, because there's a good chance it might not meet the needs of what you're looking to do. I'll give you an example. Let's say a person has a child who has some sort of addiction problem or gambling problem or something, or can't be trusted with money, spendthrift, whatever you want to say. So you put a trust in place that says that in the event of my death, my child who is a spendthrift can only get the required minimum distribution based on a single life expectancy for the rest of his life. And that way you can control, back in the day, you could control how much was paid out of the IRA every year. Now the Secure Act gets passed, and you've got that old trust in place that wanted to pay out the RMD every year for the rest of his life. Well, guess what happens? If you didn't update that trust, the Secure Act says, okay, this child is not an eligible designated beneficiary. He cannot stretch. He is bound by the 10-year rule through this trust, which means that there is no annual RMD for 10 years. And at the end of the 10 year, the whole account becomes an RMD. So he gets, boom, a lump sum payment. So that is exactly what you were trying to avoid, was getting this child the whole lump sum. He has to wait 10 years, but it all gets paid to him at the end of the 10th year. So that's how the Secure Act has impacted trusts negatively. So they're good to be reviewed if you have one in place.
You know, let me answer a couple of the other questions that have come on here, Andy, and then there's one here that I know I want to have you try to get in the middle of. Scott, you asked about taking distributions to pay estimated taxes every year. Can the money from an RMD be used for this purpose? It absolutely can. Problem is, after those estimated taxes, for many of us, we're being taxed on money we would rather let continue to defer, and that becomes the planning issue that we'd like to focus on. So, but yes, you can take that RMD money goes into your checkbook, and you can use it for virtually anything you want, including charitable gifting if you should choose. But keep in mind, if that's what you're going to do with it, the qualified charitable distribution that Andy talked about a few minutes ago probably makes more sense. But again, Scott, we can spend some time on that. I know we've talked about this at a high level, but let's dive in a little bit deeper to your situation. I'm going to go all the way back here. Cliff, I am not 100% sure what your question is. So if you could try to re-ask it. It says you have to take N before Roth conversion.
I think you said you have to take the required minimum distribution before the Roth conversion. I think that was the question.
That is true. Yes, you do have to take an RMD first and then take it out. So let's assume that you had an RMD of $10,000. If you wanted to convert money, let's say another $10,000 into a Roth, the $10,000 has to come as an RMD. It has to be taxed, and then it has to go to a checking account. And then you can do a Roth conversion with another $10,000 on top of that. So the taxable event would be $20,000. Keep in mind, if you have wages, you may be able to do a Roth contribution. We can get into that a little bit more if you have additional questions, Cliff, but it really depends on your specific situation. Tim, you've got a question here I want to make sure that Andy tries to answer. Steve, right now for married filing joint couple, you start running into the income related to Medicare adjustment amounts around $176,000 For a married couple, for those of you that are single, it comes in around $88,000 if you're an individual tax filer. Those are going to adjust a little bit. So actually, when that comes into play here for somebody that's going to be paying Medicare that moves money around this year, it comes in 2023 when they're applying. Those will be adjusted a little bit for inflation, so they aren't the exact number, but we can work with you on that. Sometimes it makes sense to pay into that first level. There's five different levels right now where you start to pay additional premiums, but keep in mind, those of you that are hitting that top bracket are paying almost 4 times more premiums than somebody that doesn't have the income. So it's really something, if we're going to go there, you want to make sure it makes sense for you long term. The larger the IRA, the more it's going to make sense to address or to look into that. To do Roth conversion, if you have non-qualified dollars to pay, I think that's the big question, Dwayne, sometimes is, do I pay for my taxes out of my IRA money that gets moved, or do I pay for it out of non-qualified? I generally find that the non-qualified to pay those tax dollars makes the most sense. Should you do an extra large one? Again, it depends a little bit on your situation. If you've got a very large IRA and you're really concerned about future taxes, it starts to make a little bit more sense. But keep in mind, we want to look at all the things that come into play there before you do that. We want to measure 2, 3, maybe even 4 or 5 times so you know exactly what to expect out of the planning we're doing. I'm going to go back, Andy, before I go to Tim's question about future CARES Act with the new administration. But you did mention something about reviewing your estate plan, and I wrote it down, and then I went off and started answering questions. I'm not an attorney. We can't do the estate documents for you, although we can help you with some planning around that and then help you coordinate with an attorney that can do that. So, you made a very good point, though. Anybody that's had a trust, and so many of our clients do, they have revocable living trust to avoid probate. You may have even named beneficiaries as a IRA. Most of that we are reviewing with clients and making sure that that's still the right strategy for them, or bringing in some some legal professionals to make sure that that's the right thing for them. Can you help me out, Andy? What are the new CARES Acts? Any new? I know that there's been a proposal for some more stimulus, but is there anything around deferring RMDs or any more additional money that could be taken out without penalties, that kind of things with the new administration coming in here that's been proposed that you're aware of?
Yeah, so a couple of things. The CRD, the coronavirus related distributions, are done with. So that ended on 12/30 of last year. However, and I just had a conversation this morning with a person in California who was in the middle of the wildfires. If you live in a federal disaster area, and it could have been a hurricane, it could have been a wildfire, it could have been any of these things that we've had.
The snowfall last weekend does not count.
I don't know if they recognize that as federal disaster area, but regardless, if they did, and that was a disaster area, you still have access to the $100,000 distribution from your IRA or plan. You can bypass the 10% penalty if you're under 59.5, and you have 3 years to spread the taxes and or repay that distribution amount, but it's got to be non-COVID related. And that's important to know that, because we actually saw an article in a major publication that said that the CRDs were continued, those coronavirus related distributions were continued. That is not the case. They ended coronavirus last year. As far as RMDs, we've seen nothing that says that RMDs are going to be waived again. But remember, the CARES Act came in March of last year. So who knows if, son of Secure or son of CARES doesn't get passed here in the spring. But as of right now, RMDs are back into effect. Everything is back to normal as it can be as of right now.
Well, and I think that comes to if we are going to make some changes, a lot of times it makes the most sense to make that as early in the year as possible. And I have a lot of our clients that would rather take their RMD right away in January, February, so they don't have to worry about it down the road, because the penalties can get so high. But on the other hand, if we wait and then they don't ever come back with anything, then you can get caught you can paint yourself in the corner there too. So would you guess, Andy, and I know you don't have a crystal ball, but would you assume that if they did come out and say no RMDs again in 2021, that they would allow you to put that back in like they did last year, or at least for the next 60 days? You could, obviously, with the 60-day rollover, but do you think they would include that? And I know you don't have any
I would think they would have to. I would think they would have to. I mean, they did that back in 2009. They did the same thing when RMDs were waived. They waited like November or something where they said, yeah, anybody that took a distribution back in January can roll it back. So they waived the 60-day requirement and they waived the 1 per year rollover rule. They did the same thing last year. You had to get everything back in by August. But yeah, I would be shocked if an RMD was taken in January and then in April or May of this year they waived RMDs again, hypothetically, that they wouldn't allow that to go back. So yeah, I agree with you on that.
Well, and I kind of personally think that for them to do the RMD waiver, the reason they do that is because the accounts got so beat up. You know, we lost 37% in a 22-day period of time, and now the markets have recovered so well. So I think we would have to see another market pullback before they would even really consider an RMD break. And I well, you know, who knows where the market's going? It's been so hot here, but which brings us to another point. If you click on there and you, instead of just wanting to talk about taxes, if you want to talk about the amount of portfolio, how we got you allocated, or even get a second opinion on where you're at, go ahead and feel free to do that. We can spend some time on that too, because I do think that we've added a little bit more risk to the markets, and not that the markets are going to pull back tomorrow, or we know they will sometime down the road, but it's a good idea to be looking at the amount of risk you want to take and are willing to take in your portfolios. So if you want to do that. Dee's asked a question about the threshold for premiums based on the gross income or modified adjusted gross. It's a modified adjusted gross income, correct, Andy?
Mm-hmm. Yeah. I believe so. Yeah. Again, lean on your. When everybody's doing these Roth conversion bracket bumping strategies, lean heavily on your tax advisor because they're going to be able to figure out exactly where you fall.
It is not based on a taxable income, so you can't deduct your way away from it. You have to take most of the income into play there. Jack, yes, so we talked about that a second ago. If you have money that has to come out, you can obviously put it in your checkbook and pay taxes on it and then do a Roth. Or yes, you can do a qualified charitable distribution. Give your money to the charity first and then look at doing a Roth conversion. Correct me if I'm wrong on that, Andy.
Yeah, make sure that you've got to be over 70.5 to be able to, and you have to be actually over 70.5 you can't be the year you turn. You got to be over 70.5 to do a QCD. If you have an RMD, make sure that money goes directly from the IRA to the charity. You can't take a distribution and then 3 weeks later say, you know what, I'm going to give this to the charity, and then that won't qualify. You cannot take possession of those dollars. You got to actually have that go directly to the charity. And I am 100% confident that every custodian out there is going to have some sort of process in effect in place where you can say, I want to do a QCD. They might say, fill out this basic form and they'll take care of it for you because it's got to go directly to the charity. Then you get the receipt from the charity, do your taxes, and you're good to go. That gets back to kind of the retroactive thing that I talked about. If you take a distribution and decide later on you want to do a QCD, there's no going back. You can't go backwards and say that back there was a QCD because it didn't go direct to the charity. It doesn't work that way.
Well, and the other nice thing about the qualified charitable distribution, if you use it this way, it would not increase the modified adjusted gross income. I don't believe in that situation. Again, something we want to check with an accountant on, but I think you may be able to do that, and it might even allow you to do a little bit more in RMDs. Again, that's something we'd want to make sure we run by the tax folks to make sure that they don't feel that needs to be calculated in there as well.
Yeah, it actually does. It's better. You can do a QCD for up to $100,000. You can do above and beyond your RMD, and it's better. I've seen comparisons where a side-by-side comparison where a person does a QCD and a person does not, and the removal of that income, but by using the QCD works better than the deduction than taking a deduction for it on the other side.
Well, I was going to just say, another planning option we got is the QLACs, the qualified lead annuity contracts, that we're starting to hear a little bit more buzz about those again. We haven't used them as much necessarily with all of our clients because really the amount that can be put into it. But what this does is allows you to take some of the money that's in an IRA, push it down the road until later on, and then you have to worry about, well, then it turns it into income. So that's something we could kind of look at too. If the IRAs become the required minimum distributions, the size of your IRAs is something we really have to start planning around. We start to look at that. But right now with the taxes that we're at, really most of the families we're working with are really focusing more on how do I get more of this money into tax-free Roth IRAs, life insurance retirement plans, things like that. So 529s, Andy, can you comment on the 529s in the CARES Act?
No real impact on those as far as we're aware of. I think 529s are great. Plow that money away as soon as you can and for as long as you can. I've got one for my son that I've been funding diligently, but I've not seen anything in the CARES Act. We've got some questions on it, but there's no real impact on there in the CARES Act of 529s.
Folks, if you have a question I have not answered, I just went through. I think I've pretty much got them all. But if I have not answered it, we'll give you a minute or so to retype in your question. Otherwise, I think we'll wrap up. I did want to make sure we answered all the questions that came through if possible, and I don't see any here that we haven't been able to really address. So if you have another question, about another 10 seconds, hit the enter or something if you're typing in something and need to add to it. Otherwise, Andy, I appreciate you helping us out here. The comment about the snowstorm was really more for Andy's purposes. He's sitting there. He still has to worry about putting on suntan lotion out there in Jacksonville, Florida, where most of us on the call here, except for a few of you that have been able to sneak off, don't have to worry about that. Anything else on your radar, Andy, you think we should talk about before we wrap up here?
No, just be careful with your taxes this year. It's going to be a little bit squirrely, like I said, with the RMDs and things like that. We've taken a lot of questions from people panicking about, the capital gains tax is going to be 39%, and this tax, it's just rumor and innuendo at this point. I've talked to Ed about it, and he says he won't even put anything in writing because nobody has any idea what's going to happen with taxes at this point. I would assume that the both sides of the aisle are going to want to play nice with each other, I hope. So we'll see what happens with taxes going forward. Anything that you read, if anybody says anything definitive, they're just guessing. They don't know. We're all just in a wait and see position at this point. So just keep on.
Well, so this week's Market Huddle with Andy Ives. Keep in mind, Andy is one of the experts that we have. He's a subject matter expert who works with Ed Slott, works on his team. Most of you know who Ed Slott is. The Wall Street Journal considers him the number one IRA expert in the country. And I've been mentoring with Ed for going on probably 13 years now. I'd have to look at the exact date, but it's been over 10 anyways. I got a little award when I went over 10 and I haven't hit the 15 years. So anyways, Andy, I really appreciate you taking some time out. I hope I didn't go too far over. I promised you 12:30 and here we are at about 12:40 Central.
Okay.
But if you have any questions, folks, if you have anything else, make sure you schedule some time or just reach out to us. The phone number's on the bottom there, 952-460-3260, and we'll make sure we answer those questions. And actually, Andy's been very generous with his time. And if it's something a little bit more complicated, a lot of times we can bring Andy in or he can help talk to other professionals you're working with to make sure we get things done right. So, Andy, I appreciate you taking some time today and all the other help you've been doing.
Thank you very much.
All right. With that said, everybody enjoy the rest of the week of January 18th. No mail today, so I guess we'll have to wait till tomorrow for the bills. But that said, everybody have a great rest of your week and well, have a nice day. Thanks again, Andy. Bye-bye.
You're welcome.